Hi, welcome back to Joe Blogs. In this video I want to talk to you about the US dollar, Argentina and Brazil. Brazil recently appointed a new president. Well, not exactly a new president. It's actually their old president, who was the president between 2003 and 2010, who was then actually barred from running for the presidency, but then that bar was overturned, he was allowed to run, and he's come back into power. And although his name is Luis Inácio Lula da Silva, he's actually just known as Lula, and that's much easier for me to pronounce. Now, one of the first things that Lula did after taking over as the president was to fly down to Buenos Aires in Argentina and to have a meeting with the president of the country. Now, as well as being geographic neighbours, Brazil and Argentina are also the biggest trading partners for each other. And as part of the recent discussions, the two presidents agreed that they should now investigate setting up a common currency between Argentina and Brazil. So in today's video, I want to talk about that common currency, what the concept is, why they want to do it, and why they're trying to move away from using the US dollar. I'll then talk about whether or not this concept is feasible, and if it's possible, we could see a common currency being applied across the whole of South America, in the same way as we saw in Europe over the course of the last 20 years. A lot of European countries abandoned their original currency and moved onto the common euro currency. So we'll have a look at how that worked and what the implications of that have been for a lot of the different countries. We'll then talk about the concept of stable coins. Now, you might be thinking, why are you talking about cryptocurrency when we're in the middle of a discussion about Argentina, Brazil, and the US dollar? Well, the reason for that is that the concept behind what they're trying to achieve here is to have some sort of mechanism that operates exactly the same way as the stable coins operate in the crypto universe. So potentially that could be an alternative that Argentina and Brazil look to. I'll then talk about the US dollar and why countries are trying to move away from being pegged against the dollar, particularly given the fact that the dollar has been so strong over the course of the last 18 months or so. And then finally today, I'll wrap up with my summary. So what I think the likely outcome of these discussions is going to be, and what the impact of that will be on the US dollar and also on the global economy. So before we get started on all of that, if I could ask you for a thumbs up at some point during this video, if you're enjoying the content, please subscribe if you haven't done so already. Don't forget, I always conclude chapters, so if you haven't got time to watch everything, you can pick and choose what you'd like to see. And if you would like to support the channel, please have a look below where you'll find links to YouTube Super Thanks and membership, as well as Buy Me a Coffee and Patreon. And as always, thank you so much if you have supported the channel. On the 23rd of January, a meeting was held in Buenos Aires in Argentina between the Brazilian President Luis Inácio Lula da Silva and Argentina's President Alberto Fernandez. Now, the purpose of this meeting was to talk about bilateral trade between the two countries, and at the end of the meeting they signed a joint letter stating that they wanted to advance discussions on a common South American currency to be used for financial and trade flows. President Lula of Brazil has since said that the talks are focused on developing a shared unit of value for bilateral trade to reduce the reliance on the US dollar. And Brazil's Executive Secretary of the Finance Ministry has stated that the regional unit of account would come alongside expanded credit to support exports to Argentina through banks that operate in the country. He said that Brazil's government would offer guarantees to banks that help to provide financing, while Argentina, a major grain exporter, would have to provide collateral via hard assets like grain, gas or oil. Under the plan, the Brazilian real and the Argentine peso would continue to exist, with the new currency targeted narrowly at trade, with the concept being that the tender would be used in clearinghouses to execute trade payments between the two countries, helping in part to trim reliance on the dollar, which is a key focus for Argentina as it has severely depleted currency reserves after years of debt crisis. So the concept that's being discussed here isn't to set up a new currency that would be circulated amongst the populations of Argentina and Brazil. This would essentially be a digital reference point that would be used for all of the trade between the two countries. So this is very similar to the way that the euro was set up initially, and obviously that then went on to be a fully fledged currency, which is now used in 20 different countries in Europe. So in order to get a better understanding as to how these discussions could develop, let's have a quick look at the development of the euro as a currency. One of the challenges that countries have when they're doing international trade is the exchange rate between your currency and the currency of the country that you're wanting to trade with. If your currency appreciates in value, so becomes stronger, it means that you have more purchasing power, you can buy more things from that other country. But on the flip side of that equation, if your currency is devaluing, if it's going down, things start to become much more expensive. And that becomes a major problem if you're a net importer, or you're having to import vital commodities such as oil and food. And we've seen the direct implications of this over the course of the last 12 months. Following Russia's invasion of Ukraine, we saw a real spike in oil and commodity prices. And that caused major problems for a lot of countries around the world because they still had to make all of those purchases and everything was becoming more expensive. But if you then add on top movements in your exchange rate, it can double down on the impact of those price movements. And that's really what we've seen in the last 12 months. The US dollar spiked in value because everybody saw the greenback as being a safe haven. And as the Fed started to increase interest rates, it also made the US more attractive from an investment perspective. So as the value of the dollar increased, that meant that the exchange rate for all of the other currencies started to devalue. So things became relatively more expensive. And then when you add on top the movements in the commodity prices, that made it even more expensive. So the exchange rate is a really big problem. And when you have two countries like Argentina and Brazil who are sitting geographically right next to each other, and they're doing more trade with each other than they are with any other countries in the world, it does seem a bit crazy that they're benchmarking their currencies against what's happening in the international markets and the US dollar. And that could be really detrimental or beneficial depending on which side of the fence that you're sitting. Now, if we take a huge step back and look at Europe, which is a myriad of different countries, back in the 1980s, we had lots and lots of different currencies, and all of those currencies were floating in the exchange rate markets. So that meant that they were moving constantly, and that made it really difficult to actually manage from a company perspective. If you're a company that's based in Germany and you're exporting your products to 20 different countries in Europe, and in order to actually do business with all of those different countries, you're having to convert your German marks, as it was back in the 1980s, for things like French francs and Italian lira. So there's a lot of headaches, a lot of complication. And if the exchange rates move against you, then you could agree a contract, and by the end of that contract, all of your profit might be wiped out just because of what's happened in the money markets, nothing to do with your business. So it's a very complicated arrangement. And to make things much easier and also to promote more trade between all the different countries, the heads of all of the different European states came together and decided that they wanted to introduce one unified currency called the euro. Now, changing the currency of one country is quite complicated, but trying to change multiple countries at the same time, all to convert onto the same single currency, is horribly complicated. And the process actually took more than 20 years to become fully effective. The first stage that Europe introduced in 1979 was called the European Monetary System, whereby all of the different currencies in Europe were benchmarked against each other, and the plan was to keep all of them within a very narrow band. So essentially what that system did was to fix all of the exchange rates against each other. And you may have heard the famous story that the UK actually signed into this system, so they agreed to be part of this common currency discussion. However, the benchmark that they'd gone in at was seen to be far too high. And George Soros, the famous investor, worked this out and started shorting the pound. He was selling it in the international markets and basically broke the Bank of England. And within a very short space of time, the UK actually pulled out of the European monetary system and is not part of the euro. Now, the European monetary system actually lasted for 15 years, and an agreement was signed in December 1991 to introduce the euro. However, it then took another 8 years before the euro was introduced. And when it was first introduced, it was an invisible currency. So it wasn't in physical form, you couldn't use it in terms of notes and coins. It was solely used for accounting purposes and electronic payments. So basically it was a reference point. If you were doing a contract between two countries, you could agree what the payments were going to be, but actually you still had your German marks and French francs and Italian lira at that point. And it wasn't until the 1st of January 2002 that the euro was actually distributed as a real currency. And at that point, it was adopted by 12 countries. So the Big Bang went live on that day, and from that moment onwards, all 12 of those countries operate solely in euros. They abandoned their previous currencies. Now, over the last 20 years, another 8 countries have joined, so there are now 20 in total, and there's another 6 pending approval. But I think what's really interesting when you look at the history of the euro is, firstly, how long it took to actually get it from being an idea that everybody signed up to actually a reality. It took around 15 years for the euro to become a physical currency. But if you also look at what happened with the UK, If you get your initial starting point wrong, if you're not coming in at the right level, then it's never going to work because you're locked into that exchange rate forever. You can't get away from it. So the negotiations in terms of how to set these initial levels is something that's firstly very difficult to achieve, and secondly really important to the success of your economy. So why do Argentina and Brazil really want to start talking about a common currency? What's the big driver right now? Well, I mentioned it at the start of the video. Brazil's president is new to the job. He's just come into power and he's trying to improve his popularity. There is a real split in Brazil between the supporters of the old president and the supporters of the new president. And it's going to be very difficult to be able to win over the supporters from the old president. The left and the right don't tend to merge in Brazil. So what he's trying to do is reach out to the other countries in South America and try to create a big South American feel. Brazil could be the leader of an enlarged South American trade consortium. That's the concept. And obviously Argentina is the biggest single trading partner for Brazil. So that's the obvious place to start your tour of the continent and to try to raise your profile. And by going to Argentina and offering the concept of a common currency, he's starting the ball rolling on South America becoming a big unified force. Now, from Argentina's point of view, they are in a state of disarray. If you watched the recent video that I posted, I explained exactly what's been happening. But basically, Argentina has been taking on far too much debt for a very long period of time. They can't service that debt, and it looks likely that they could default on their international debt obligations for the 9th time. And inflation in Argentina is off the scale. It's up at around 100%. And it's very difficult to work out how Argentina is going to get itself out of this position. So basically what's happened here is the Brazilian president has flown in and offered an olive branch and said, we would like to do more trade with you and we'd like to set up an arrangement whereby we don't have to benchmark against the US dollar because the Argentinian peso has tanked in value against the dollar. So this arrangement would be very attractive from Argentina's point of view. So the Argentinian president has said, yes, we are definitely interested in doing that. The Brazilian president is obviously interested because he's trying to raise his profile and to become more popular in Brazil. So the question really is, will it happen? Will it actually come to fruition? Well, the reason that I wanted to walk through exactly what happened in Europe when they introduced the euro was firstly to show you how complicated it is to be able to get a deal like that put into place. And then secondly, how long it would actually take in practice to actually deliver this form of common currency. It's going to be really challenging for both of these countries to be able to set it up. And I would doubt within the short term that we will see much progress on this. Now, I mentioned earlier in the video that the concept of having a benchmark for both Argentina and Brazil when they're doing trade is very similar to the stablecoin. And a lot of commentators have stated that the proposal is identical to what stablecoin achieves. When you look at stablecoins, the whole concept behind them is to provide the benefits of cryptocurrency in terms of not having a physical form, being able to transact without having to use banks and all of the establishment. But you get stability. So one of the things that puts a lot of people off cryptocurrency is the volatility. It can move wildly in terms of the valuation on a daily basis. And the idea with a stablecoin is that it's benchmarked against the US dollar and therefore it never moves. So if you put your money into stablecoin, you won't make a lot of money in terms of it appreciating in value. But if you're using it for transaction purposes, for buying things, you know that it's going to remain stable and therefore you can be happy planning ahead because you know what the value is going to be. But the big flaw in that whole argument is that stablecoins are benchmarked against the US dollar. And obviously the US dollar is floating in the international markets. So the valuation did go up rapidly after Russia's invasion of Ukraine, but it has also come down significantly over the last few months. And so the stable coins are moving in line with the value of the dollar. Yes, one stable coin equals $1, so there is parity there, so you've got stability. But if the value of the US dollar has risen by 50%, then obviously the value of the stable coin will have gone up by 50% and vice versa when the dollar falls. So the comparison between what Argentina and Brazil are trying to achieve and what stable coins are achieving is completely wrong because the stable coin is benchmarked against the dollar and Argentina and Brazil are trying to do the exact opposite. They're trying to move away from being benchmarked against the dollar because it's detrimental to the value of their currencies when the dollar is rising. So what's the summary and conclusion today? Well, I wanted to post this video really to talk about what's going on in Argentina and Brazil, and we've done that in some detail. but also to look at the implications of this for the US dollar, because the US dollar is the dominant currency all around the world. I recently made a video where I was looking at the number of FX transactions globally, and 88% of all of those foreign exchange transactions involve the US dollar on one side or the other. So that is a massive percentage. Now, this is obviously something that President Putin of Russia has tried to change over the last couple of years. He's been trying to get people to move away from what's known as the petrodollar, so all of the oil transactions being benchmarked in dollars. He's trying to get everybody to start using the Russian ruble. And as we saw following the invasion, he actually made statements about natural gas, saying that all countries who were deemed to be unfriendly, so anybody who was supporting Ukraine, had to make all of their future payments in Russian rubles. And that meant that some countries immediately stopped all of their supplies. They said they wouldn't do it, Poland and Bulgaria and Finland being good examples. But other countries such as Germany and Italy, who didn't really have a choice because they were so dependent on natural gas, had to agree to start making those payments in Russian rubles. So President Putin wants the ruble to become an equivalent to the US dollar, but that's not happening at the moment. It's not really taking off. But the major problem that everybody has with regards to the US dollar is that when it appreciates in value, when it becomes strong, like it did in 2022, it means that everybody else's currency is devalued, and things that are benchmarked in dollars become more expensive by definition. So we had that double whammy at the start of 2022, that the price of oil and wheat and natural gas and other commodities all went up in the international markets in dollars. And then the value of your currency fell against the dollar. So it meant that it became even more expensive in real terms. And everybody really wants to break away from that. But the problem that we've got is that you always need a benchmark. When you're doing a deal between two countries that have different currencies, you have to have a benchmark, you have to have an exchange rate. And over the last 50 years or so, the US dollar has become that benchmark currency. It's just much easier because the US dollar historically has been relatively stable. So when you've got two countries like Argentina and Brazil who are doing transactions, they are using the US dollar to benchmark the price of those transactions. Now, obviously from Argentina's point of view, that benchmark has really moved against them over the course of the last few years because they've seen a massive deterioration in their currency value. And they're now trying to get away from that and use some other metric. So this idea of Brazil and Argentina setting up this common currency is a good idea in terms of the level of trade that they're doing and trying to stop one or the other losing out. But the question really will be, what level would it be set at? Where would you set that benchmark today? Now, the obvious choice is to say, well, we'll take today's exchange rate. Whatever your exchange rate against the dollar is now, and our exchange rate is, we'll just use those two. But the problem that that would cause was that Argentina would be forever at a disadvantage because their currency is very low right now. This is similar to what happened with the UK when it went into the common system in Europe. It set its exchange rate at the wrong level, quickly realised it wasn't going to work, and then had to pull out. And I think that's exactly what would happen here. If Argentina and Brazil did get to the point where they could agree a common currency, setting the price of it would be virtually impossible right now because Argentina would want a price that's above the current levels, and obviously from Brazil's point of view that would be detrimental to them because they would be giving away current value for the future appreciation of the Argentinian currency. So it's going to be really difficult to bring into place. And I think this really is the point of the video, that even though a lot of countries around the world want to move away from benchmarking everything against the US dollar, because that system is so embedded and so established, it's really difficult to do it. Now, cryptocurrency, like it or loathe it, is something that was designed to try and move away from this. Bitcoin has no relationship to the US dollar. It has its own value. But the problem that you have with cryptocurrencies, as I mentioned earlier, is that they tend to be very volatile. So the price can move up and down wildly, often within one day. And that's the last thing that you want if you're a business trying to do long-term contracts with people. You can't have the value of the currency that you're either being paid in or you're paying other people moving 50% or 100% in a short space of time. It just wouldn't work because you'd wipe out all of your profits and potentially become insolvent. So that's why people use the US dollar, because long-term they believe in it and they think that it won't move too wildly. And I think, unfortunately for everybody else in the world, it's likely that we will remain in that situation for at least the foreseeable future. So hopefully you found today's episode useful, informative and thought-provoking. If you've liked what I've said, then please give me a thumbs up. And thank you so much for watching this video all the way through to the end.